Rashi, what is your big bet?
So, let's keep valuations aside for the time being. Let's look at where we're going to see better than what earnings we're expecting. And in Sunil's perfect world of the W-shaped kind of recovery that we see, we'll get the opportunity with the valuations. And, in terms of a trend that I'm picking up that is changing, as more women enter the labor force, consumption patterns are changing and changing dramatically. More women working, women have always managed household finances, but that's a very different kind of spend versus when they're earning themselves and spending on themselves. So when women earn themselves and what do they spend on, right? It's convenience to make life easier at home, and that could come in the form of, say, quick commerce or e-commerce, gadgets, electronic gadgets at home, because you need to have more time on your hands to be out. It's personal mobility, and we're seeing that probably with scooters, would get to smaller cars, etc. And it's also on the personal well-being. So whether it's fashion, whether it's beauty products, skincare, etc. And fashion and beauty are already a $110 billion market, of which beauty products is only $20 billion, which is expected to get to $90 billion by 2037. And $40 billion of this is supposed to come from the e-commerce platforms, right? So these are very large trends.
With the disclaimer, and I think all of you are saying the mantra is keep expectations low. Don't look for multi-baggers. It was still, as Sunil said, where do you find the alpha?
So these are compounding markets. I don't think these are markets that offer meaningful number of multi-bagger opportunities. If you look back, multi-baggers have materialized even when a new business model was listed in India, which is not happening anymore because they go to the private equity route more often than not, or when the markets were in a deep downturn, or when, let's say, consumption is not that cyclical, but capex can be deeply cyclical. So in 2000, when capex was down for 10 years, you could find multi-baggers there. I don't think in this market there are multi-baggers to my mind. This has been a narrative-driven market. If you look at last 5 years, 3 out of 4 investors have joined the markets for the first time. So, and they have been influenced heavily by narratives. So I would rather avoid those narratives because most narratives have been overplayed in terms of valuations. Yet I would say, as Neelkant said in the previous session, I think capex should grow faster in India than GDP. I think consumer discretionary space should also grow faster than GDP, and Rashi also referred to a segment of that. I think, however, I would simply also be careful that top line growth alone need not lead to profit growth. So we have to be careful to buy into categories where there are some entry barriers, some competitive advantages, and but generally I would say these are compounding markets, and there are no obvious mega return kind of opportunities in this market tomorrow.
But industrials and capex is the spot where you think maybe market is underpricing. Expectations have dropped off there, especially after the budget, etc. People said, well, maybe the regime is changing, it's more consumption, etc. And after a few years of very strong growth. But you think, as Neelkant also pointed out in the last session, that is not true. So that still remains a spot to look for ideas. Capex and industrials.
So I think, yes, industrial should grow faster than GDP. And only thing is you have to be careful. The margin expansion in some of these companies looks to be unsustainable. So, but still, I would be quite alert to look for companies that have some advantages, because that space should grow meaningfully faster than, so that narrative is right, it just got overvalued. But if it again offers you reasonable valuations, I think there is merit in that space. So I would agree with that.
I would be remiss if I don't ask you about PSUs, Prashant, PSU banks, etc. I mean, stocks have fallen a long way now. What's your sense? How do you think about that?
So I think we should, as I have said multiple times in the past, it's wrong to club all PSUs together. There are PSUs that can compete well in the marketplace, and there are those who are unable to do so. But even the good ones, I don't think there is any meaningful mispricing at this point of time. Please remember, these stocks have gone up 5x to 15x. And so I would say, but there are, in the large cap space, I don't see much excesses also. That's the good thing in this. In the small mid cap, there are still excesses, and most PSUs are large cap. So I don't find the valuations excessive either.
Fair enough. Utpal, where are you looking for ideas? Alpha.
Instead of thinking about sectors, I would say that this is the time to think about superlative management teams who've demonstrated the ability to pivot, the ability to adapt, who are working on expanding their addressable opportunity and elongating their competitive advantage. There are very few of them, and this kind of market volatility actually helps in being able to buy them. And I fully agree with what has been discussed earlier, that we are looking for compounders here rather than multi-baggers. But I feel that the compounding longevity will be better with these kind of superlative management teams.
And we had one before, right before this panel, right? Anish was on stage, and fantastic job there. But anything specific, Utpal? I mean, since it's about superlative management teams, I don't know if you want to put a few out there.
So we are looking for management teams who are able to embrace the disruption, who are not dependent on economic growth for their growth. We are looking for management teams which can take out costs, which can think of very different price points compared to what they've been thinking of earlier. I think those would be the characteristics to look for.
Fair enough. I think we are right on time. I think the message from the panel is, if you want to be happy in markets and in life, keep expectations low. That's I'm summarizing it correctly, Sunil?
I think it's always better to have low expectations, because, if it comes better, you're always happy. But we also have to embrace the reality.
Right.
I think to expect CAGR returns which are extraordinary, then, I think it will all boil down to no one will set up industry and no one will work. Everyone will just want to be
now you're getting into a...
It's a fact, So I think you have to be realistic about it. But see, in the broad scheme of things, we could have said that, things were very expensive last year, but no one came out and said that. Right now we are all trying to introspect. That's the nature of the market. Things definitely are decent, but at the same time there are challenges also. I'll just highlight one challenge. A lot of corporates are also taking decision now based on market cap of that particular sector rather than profitability. And we have seen that happen in paints, cables, some other sector will come up. I don't think the size of profit is what is driving those decisions. Maybe the size of market cap is driving those decisions. And that will put pressure on the existing companies. On the other hand, because the markets have not been very, very buoyant, the ability to raise capital either by way of private equity or IPOs will reduce. And that will lead to reduction in competitive intensity for the already existing players. So it's going to be a very interesting next couple of years. And I think that is good, because in a market which was like what was last 2-3 years, even your mistakes made money. And now, it's really going to be a good grind. And I think that is what you need if you want to accept the challenge as a portfolio manager.
Sunil, Rashi, Prashant and Utpal, thank you very much for being lovely guests and all those insights, some ideas here for the audience as well. And thank you very much for being a wonderful audience. Thank you very much.